Good afternoon. Welcome to today's webinar, Commercial Mortgage Lender and Borrower Foreclosure Issues. Numerous commercial mortgage defaults and bankruptcies have occurred and will continue to occur during 2011 and into 2012. The five leading causes of commercial mortgage defaults and bankruptcies are a dramatic increase in the property's vacancy in combination with the decline in market rental rates that caused the property's value and annual net operating income to diminish significantly, and in some cases by 50% or more. The property's first lien, second lien, or mezzanine financing has come due and cannot be easily repaid because the purchaser grossly overpaid for the overfinanced the property. While the property continues to have enough income to pay its expenses and even debt service, appropriate reserves were never properly anticipated and created, and therefore the property does not have sufficient cash available to pay the tenant, finish, and leasing broker commission costs associated to retain and or attract new tenants to minimize vacancy. The interest rate on the mortgage increased so much due to an existing formula that the property's net income cannot pay its debt service. And finally, bad management, often with interests that are in conflict with ownership. Among the other items that today's webinar will address are lender issues to be investigated and actions to be considered when a default occurs, borrower issues and actions to be addressed when the potential for default is imminent, some special problems to be confronted when dealing with a defaulted or defaulting loan that is in a commercial mortgage-backed securities pool. The presenter for today's program is Bruce Coyne. Bruce has over 40 years of full-time experience in the interrelated disciplines of commercial income property financing, valuation, and development. He's a co-founder and for 35 years ran Progressive Mortgage Corporation, a commercial mortgage banking, brokerage, appraisal, and consulting firm and regional commercial mortgage loan and servicing correspondent for a number of major insurance companies. In 2007, Bruce sold Progressive to the Philadelphia office of U.S. Realty Capital, LLC. Bruce has personally closed in excess of $1.5 billion of commercial mortgage financing on all types of income-producing real estate. Structures included first and second mortgages, construction loans, permanent loans, immediate and forward commitments, joint ventures, participating mortgages, wraparound mortgages, standbys to lend, standbys to purchase, mezzanine loans, and credit enhancements. He has sold, leased, and managed and foreclosed a variety of income property types. In 1970, he was instrumental in the formation of Fidelco Growth Investors, the first commercial mortgage REIT in the Philadelphia region. Between 1973 and 2007, he assisted a business partner with the planning, development, financing, management, and leasing of two one-story office developments totaling over 550,000 square feet. He has lectured to joint undergraduate and MBA classes at the University of Pennsylvania's Wharton School, as well as classes of Temple University and Widener University. He has been published numerous times, including issues of the New York Times, Real Estate Review, the Appraisal Journal, and other publications. He is an IDECC certified distance education instructor, written 4 7-hour, 1 4-hour, and 1 30-minute IDECC, Anarello, and AQB approved online commercial real estate education courses. He's provided numerous expert reports and court testimony for law firms and clients as both plaintiffs and defense experts. During this presentation will take 2 question and answer breaks. If you have a question, we do ask that you use the chat or Q&A feature found on the right-hand side of the screen to submit your questions. We encourage all attendees to submit questions throughout the presentation. Tomorrow morning, I'll send out an email with a link to the archived recording of the webinar. We do ask that you take time to fill out the survey that will appear on your screen after the webinar is over. I'm now delighted to turn the program over to our distinguished presenter, Mr. Bruce Coyne. Bruce, the program is now all yours.
Thank you, Matt, for that very nice introduction, and welcome to everyone who's attending the webinar today. Some basics I'd like to review before we get into the foreclosure issues that are so appropriate for today's topic. I'd like to review some of the interesting statistics that perhaps necessitated the need for this webinar. Between January 1st of 2007 and March 31st of this year, the FDIC has closed a total of 347 banks, with more foreclosures anticipated to occur. The primary causes of most of those bank failures have been bad commercial real estate loans attributed to institutions that in most cases failed to have any experienced commercial mortgage loan underwriters or loan officers on staff. In addition, a few credit unions have been closed for the same reason. Now, in 2006-2007, the commercial mortgage-backed securities industry became the nation's single largest lender of commercial mortgages. They're monitored by the rating agencies, and one in particular, Fitch's, continues to monitor the defaults. In 2009, Fitch's reported that there were $35.49 billion of CMBS mortgages in default. In 2010, that increased by over 20% to $57.58 billion as 1,477 more loans totaling $22.9 billion went into default. It's a $580 billion industry, and they're predicting that 12%, or about $65.2 billion, will be in default by the end of this year. In addition, the CMBS market started rebounding in the summer of 2010, and new financings are now referred to as CMBS2 as opposed to QE2, and already 2 of those loans are in default. That's outstanding. Let's talk a little bit about the basics of commercial mortgage financing. Types of loans are used to finance tract developments, which most people think of as residential housing, but it can also include an industrial, business, or office park. And of course, they're used to finance income property. For existing properties, there are really 5 primary types of loans. A permanent first lien mortgage, which is generally deemed to be a long-term fixed-rate mortgage. Years ago, they would be for a full 25 or 30 years. Then they started dropping down with 15-year balloons, 10-year balloons, and even today, loans with a 5-year balloon are considered permanent mortgages. Then we have the mini-perm first lien, which is usually provided on a short-term basis by a construction lender to make sure that there is some type of carryover at the end of a construction loan if no permanent financing is available from another source. We have what are known as bridge first lien mortgages, which are interim financings designed to allow a property to perform from one level to another over a defined period of time and then be refinanced. We have the mezzanine loan, which really has taken the place of the second lien mortgage. And mezzanine loans sometimes can come without the consent of the first mortgagee or with the consent of the first mortgagee, often just being a partnership lien. And then we have joint ventures or participating mortgages wherein the lender is a partner or pseudo-partner in the venture being financed. Alternatively, we have construction loans that are typically used when you want to finance a proposed property, a completed but not occupied property that needs some additional work to help it become occupied, properties that are not completed are only partially completed and need such financing to facilitate completion, and we often have completed and well-leased properties that need additional funds to refit the interiors for a new tenant, a new type of tenant, to provide tenant finish, to cover the leasing commissions. And we have joint ventures, and such financing is often used to provide the ability to reposition a property, converting it from one type of use to another. For example, some older apartment buildings have been converted into hotels, and some old industrial buildings have been converted into office buildings. There's a variety of income property lenders, and they are financed by the following types. Insurance companies with exceptions, and they will strictly finance income property. Commercial banks, they'll finance the tract developments, owner-occupied properties, as well as income properties. Credit unions, they'll finance tract developments, mostly residential, owner-occupied properties, and some income properties. The commercial mortgage-backed securities market typically provided permanent financing for income property with some exceptions. Fannie Mae, Freddie Mac, they provide permanent mortgages for multifamily projects only. Pension funds, real estate investment trusts, and the FHA, which provides permanent and often combination construction permanent financing for multifamily properties. On the borrowing side, there are basically 5 structures. The borrower can be an individual, they can be a general partnership, they can be a corporation, they can be a limited liability corporation or a limited partnership with a general partner, and they can be a TIC or a tenant in common arrangement. The problem we find with the tenant in common arrangements is you need a unanimous decision to make a decision affecting the property, and that's often very, very difficult to obtain because of the different opinions of the individual TIC owners. These mortgages are always served by professional servicers. The insurance companies and some banks, the DUS, Fannie Mae, Freddie Mac, and FHA, have mortgage correspondents. The mortgage correspondents for Fannie Mae, Freddie Mac, and FHA are often referred to as DUS lenders, standing for Direct Underwriter Servicer. They originate, they underwrite, and they place the loan with Fannie Mae, Freddie Mac, or FHA. Since the meltdown in the summer of 2007, we've seen a tremendous increase in the number of multifamily projects financed by the FHA. The CMBS loans have been serviced by what were known as master servicers. Sometimes they were companies owned by the CMBS originator, and other times they were just independent contractors. A new servicer has appeared on the horizon in the last 18 months or so called a special servicer. And the special servicer has come out as a result of the paralysis that the trustees had on these CMBS issues. If a CMBS loan went into default and someone proposed a resolution of the default, the trustee would have to petition and find all of the bondholders and get a unanimous decision. So to overcome the paralysis in light of so many defaults, the regulators created something called a special servicer. And the special servicer takes over when a loan is in default and has the authority to make decisions and bind all of the bondholders in a class of CMBS issues. Some examples of these special servicers are a company called Berkadia, which is really Berkshire Hathaway, Warren Buffett's company, LNR, CW Capital, J.E. Roberts, Midland Mortgage, which used to be PNC, a company called CIII, and Torchlight. I don't see any questions yet, so if you'd like
Bruce, there are a couple questions that have come in to me, so why don't we take our first Q&A break, if that's okay with you?
That would be fine.
Okay, excellent. And to all the attendees out there, please use the Q&A or chat feature to submit your questions if you have them for Bruce. Bruce, what's the concern about obtaining a consent agreement from a first mortgagee as it relates to obtaining a mezzanine loan?
Well, that's a very good question. Virtually all first lien mortgages have what's known as an alienation provision in the loan documents. And what that basically says is the mortgage cannot be assumed by anyone without the express written consent of the first lien mortgage holder. And that's to prevent a borrower from selling the property to someone that's not nearly as financially strong or possessing the operating expertise as the original borrower. And that would make the lender very nervous. So A mezzanine lender comes along and wants to put a second lien on the property, and there's a provision in the first lien mortgage that also says no secondary financing can be obtained without the express written consent of the first mortgagee. So the mezzanine lender is very concerned in most cases about lending money to a borrower and not having the legal right to file a second lien behind the first, and not having a pre-approval, in a sense, to assume the shoes of the borrower in the event there's a default and take over the first mortgage. So some mezzanine lenders are willing to take the risk of not asking permission from the first mortgage lender. They don't file a second lien. They file a lien against the borrowing entity, and they worry about it later. But a lot of mezzanine lenders want the first mortgage lender to approve that they can file a second lien and not default the first mortgage, and approve that in the event there's a default in the mezzanine loan, they can foreclose on the borrower and assume that first mortgage without having the first mortgage go into default. So there's a substantial risk difference between the kind of mezzanine loan that gets approved by the first mortgage lender and the one that doesn't get approved by the first mortgage lender. And usually there's a vast interest rate and sometimes equity participation difference between the two. Very good question.
Excellent. Thank you so much, Bruce. We have another one here, and it relates to slide number 5. It references one of the bullet points that you had on slide number 5, which said that credit unions only do some income property loans. Can you expand or expound on why credit unions only do some income property loans?
Yes. The biggest reason is that they're very small. Most of the credit unions have difficulty making a loan of more than $300,000, $400,000, $500,000. And while there are some small commercial mortgages out there, in the context of what we're talking about today, we're talking about multi-million-dollar loans. So in order for a credit union to make a large loan, they have to get together in a consortium and participate with each other. Now, there are a few larger credit unions that see the wisdom in doing this, and they've actually retained, a mortgage expert in-house as a loan officer who will look at a multi-million-dollar transaction, analyze it, underwrite it, and approve it, take a piece of it, such as $500,000 on a $2 million mortgage, and then go out and contact a number of other credit unions seeking them to participate for $200,000, $300,000, $400,000, $500,000 in a consortium to aggregate the $2 million. So while there are a few credit unions that are doing that, we're not finding very many, simply due to the lack of commercial underwriting expertise in-house and their physical size.
Excellent. Great. We have a question here from Celeste who asks, can you discuss guarantors and which lender sources are more likely to obtain a guarantee?
That's a good question as well. Insurance companies rarely require a personal guarantee for a multi-tenant property. Their attitude is, we know how to underwrite these, and if it requires the additional surety of a personal guarantee, we probably won't do the loan. Notwithstanding, if an insurance company does a property that has a temporary blemish that momentarily looks like it will be overcome, they may take a short-term guarantee from a borrower, and once the difficulty has been overcome, the guarantee will eradicate. The majority of commercial banks in the United States, with rare exception, always require some form of personal guarantee on the loan, anywhere from 25% to 100%. They look at it as a philosophical issue. If the borrower is not willing to personally guarantee the loan, why should we do the loan? And the problem you have there is every once in a while you'll find a commercial bank that wants to be a little more aggressive, and they'll do a loan without a personal guarantee. And when that happens, that borrower forever and a day thinks every bank in the United States will do his loan without a personal guarantee. And that just doesn't happen. So it's a philosophical issue. The credit unions, they're the same. They prefer personal guarantees. The CMBS market, one of the reasons the CMBS market was so beloved is virtually all of their loans were done on a non-recourse basis. Now let's take a minute and discuss the difference between recourse and non-recourse. It's a generic understanding. The generic definition of non-recourse means that the borrower or any of the individuals comprising the borrower will not be sued personally by the lender in a non-recourse loan in the event of default. The lender says, I'm a big boy, I made the loan, it went bad, I'll take the property, go away. But they then created something called carve-out provisions, which are really limited liability situations. And there are a number of them that differ from lender to lender. But the basics are this. If in a foreclosure the lender finds out that the borrower committed a fraud, if in a foreclosure the lender finds out that the borrower has allowed a wasting away of the assets or has taken money from the job that was supposed to pay operating expenses or real estate taxes and not paid those expenses and put them in his pocket and ran away, or with a very subtle difference in most cases, if the borrower files voluntary bankruptcy as opposed to involuntary bankruptcy in an attempt to frustrate the lender's ability to obtain title to the property, then the loan becomes full recourse to the borrowing entity and any or all of the principals named in the original financing commitment. I hope that clarifies.
Okay, excellent. I do not see any other questions in the queue, so why don't we continue on with the presentation of content, Bruce?
Okay, let's move forward. Let's review some of the causes of loan defaults. And from my experience, as Matt reviewed a little earlier for you, I have found 5. The first usually is as a result that the existing financing has come due, and in combination with a decline in the property's value and an increased difficulty of obtaining mortgage financing, such has occurred in the last 2 years, the borrower cannot repay the existing loan balance via either a sale or refinance and is unable to choose or chooses not to pay the difference to satisfy the mortgage. Some of the things that have changed in the last few years concerning the underwriting of financing is the lender standards. Many loans were being done at 80 and 75% to appraised value, and now are being done at only 70% of appraised value. The loan to debt service coverage ratio has increased. Pre-2007, we were seeing multi-tenant properties being underwritten with 115 and 120 debt service coverage factors. Now it's tough to get a loan done at below 1.25 debt service coverage. The reciprocal of that, meaning that 80% of the net operating income can go to debt service, but no more. They've also increased the vacancy allowances that they use for underwriting purposes. They've increased the reserve allowances that they've used, and in many cases they have increased the capitalization rates. And if any of you out there have done multifamily, you'll know that in 2006-2007, many of these apartments were being bought with 5% capitalization rates when the annual constants on the mortgage were greater than 5%. Second reason is that the property was encumbered by a second mortgage or a mezzanine loan that came due. It could not be repaid when it was balloon due, and so the lender, the mezz lender or the second mortgage lender, instituted foreclosure, causing the borrower to then default on the first mortgage. Defaults have occurred due to a substantial increase in vacancy and a decline in market rental rate for the property. Its net income after taxes and operating expenses became insufficient to pay the debt service on a long-term basis, and its reduced value is insufficient to generate repayment of the mortgage via a sale or refinance. This has happened to a great number of properties, particularly office buildings, in the last 24 months. We haven't seen that occurring to apartments. We've seen some of it occurring to retail, mostly the smaller retail, not the big multi-tenant, multi-anchored centers. Of course, hotels and motels are a great example of this. Their vacancies really tanked and put a lot of them into a default. Another reason is that the property is unable to pay its current debt service for a short time but there are no significant reserves on hand for the borrower to make the necessary improvements and to offer the tenant finish allowances and to pay brokers' leasing commissions to improve the property and reduce vacancy. This is one of the biggest problems we see with office buildings right now. So the borrower stops paying the mortgage and either uses those funds to make the improvements or keeps the money hoping to force the mortgage lender to restructure the loan and fund the improvements necessary. I've just looked at 60 or 70 properties aggregating over $1 billion that are all in default or imminently in default. And the primary reason is they were done with tick investors who can't make decisions. And when the deals were structured, the sponsors never created the proper amount of reserves, choosing to take as much net cash flow as possible and pay that to the individual investors to give them a high rate of return to seduce them into investing in the transaction. Now, as the property got to be 3, 4, and 5 years old, and tenants insisted on tenant finish to remain, or they left and downsized and other tenants needed to be attracted, the borrowing entities did not have the money to attract new tenants, and so these loans are going into default. And one of the other reasons is that the interest rate on the mortgage increased so much that the property's net income cannot pay the debt service. This hasn't happened a great deal, but in some cases it has. It usually occurs due to a pre-existing formula and what I would call a teaser rate. The lender offered 1, 2, 3, even 5 years of a low interest rate or an interest-only situation, and at the end of the 1, 2, 3, or 5 years, the interest rate was escalated on a formula and amortization was required, and oftentimes that's enough to break the camel's back. For example, if a property had a 6% interest-only loan for 3 years, and at the end of 3 years it was to begin amortizing on a 25-year basis, the annual mortgage constant is 7.732%, which requires an increase of 1.732% in the annual debt service. So if you were doing a $10 million property, the mortgage payment would have been $600,000 a year, but would be $600,000 a year. And if you then had to amortize it, it would suddenly become $773,200, and oftentimes that increase is enough to be the difference between a property that's struggling, having the ability to pay its interest, and not having its ability to pay its amortizing mortgage. Let's review some significant lender issues when defaults occur. And many of these are questions. The first question that comes to mind is, why did the default occur? And as we discussed, there's a variety of reasons that it could have occurred, including things like fraud, death or incapacity of the borrower's primary partner, a natural disaster such as a flood, a fire, or tornado, and not having the borrowing entity be in a standalone bankruptcy remote situation. Sometimes there are multiple properties in one of these borrowing entities, and while the borrowing entity in the instant is fine, some other property in that partnership has gotten into trouble. It drains the aggregate net income from all of the properties, pushing the better properties into default. Second question that the lender has when a borrower comes and asks for some relief is the borrower in real trouble or is he bluffing? It's a credibility issue. With all of the foreclosures that are going on now and all of the talk we see in the media about lenders rolling over and being pushovers, some borrowers are attempting to take advantage of what I would call current market conditions, and the minute they have the smallest of problems, they run to the lender and beg for help. So the lender has to decide whether there's a real problem or if the borrower is bluffing. And certainly you want to take a step back as a lender and see if any fraud was originally committed. Remember that A lot of these loans were done in a halcyon period where lenders were go, 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 get it done, get it done, get it done, and they may have missed something in their zeal to get the loan committed, closed, make the fee, sell it, and hopefully get away without any liability. The question is it a temporary or a long-term problem? And once they've looked at those first 4 questions, they then need to start thinking about what to do. The easiest way for a lender to help a borrower, especially with a short-term problem that appears to be solvable in the next 6 to 12 months, is to waive the amortization and or accrue some interest on the loan. Of course, lately we've seen many lenders doing what's known as extend and pretend. As long as there's sufficient income from the property to pay the debt service, they continue to extend the loan and pretend that there's not a problem, hoping that time will cure all. Of course, they have to think about restructuring the loan. They have to think about taking a mortgagee in possession action. They have to think about a foreclosure. They have to think about accepting a deed in lieu in a negotiation. And then when they've thought about all of those things, they have to consider if they have an in-house staff that has the ability and experience with REO and workouts. Many institutions do not. And there's a little semantical breakdown there. We refer to everything as REO, but with the banks, REO means the plant and asset that they own, such as their headquarters and their branches. It should say OREO, other real estate owned, meaning the real estate that they take in a foreclosure. Often they don't have the ability to make and justify decisions. If it's a private lender, you can often find the right person in the institution with some knowledge that can address this properly. If it's a CMBS lender, you have to get the loan into the hands of the special servicer because the master servicer or the trustee can't make any decisions to address a foreclosure. The lender that's thinking about a foreclosure has to think about its source of funds that would be necessary to pay ongoing tax and operating expenses, as well as deferred maintenance and any required tenant finish and leasing commission costs to attract new tenants, and they're not usually available from and out of the rents. This is also true if the lender takes a mortgagee in possession action, because once they do that, they're effectively operating and managing the property. They have to get their legal as well as practical ability to sue for damages considered. They have to look at, did the loan have recourse? Was the loan non-recourse? But was there some liability under a carve-out provision, such as a filing of bankruptcy to frustrate them? And is the borrower judgment-proof? Oftentimes these borrowing entities and even the individuals have little or no assets because they've all been watered down in the last 2 years. And so even though you may go for a judgment, you may never be able to collect it. If we're looking at CMBS loans, the loan needs to be moved from the master or primary servicer to the special servicer. And when that happens, there are also some problems. There are potential conflicts of interest. Some of these special servicers actually purchased the lowest, highest risk levels of the different tranches in the CMBS issue, so that not only could they be appointed as a special servicer, but so that they could have some control over the decision-making as to the disposition of the loan and the property. And so sometimes the special servicer who wants to earn a management fee for operating the property doesn't want to see that management fee go away. And if they own some of the tranches, they may want to hold on to the property when the other tranche holders want the property to be sold. And that's because the subordinate tranche holders are at risk of loss. The very low AAA, AA, A, even down to BBB tranche holders oftentimes are really at no risk of loss. So we have to watch the potential conflicts of interest when there's a special servicer involved. And we have to look at the appraised value issues. A lot of these lenders defer getting an appraisal for fear that the value will come in so low that it causes another problem that they must deal with. And quite frankly, in my experience, I find a lot of them don't really understand the essence of an appraisal. It's not just the number, but the things that comprise it, such as the assumptions about market absorption and market rents and how long it will take to lease the vacant space. And they tend to look at the number and don't read deep enough to find out that perhaps the assumptions in the appraisal were either incorrect or too aggressive. They're just not trained properly. There's a concern about wasting away the asset. If they allow the borrower to remain in place for a while, is he going to be a good borrower and continue to maintain the property, or is he going to allow deferred maintenance and other things like that to arise? The lender then has to select the proper strategy. Do they want to foreclose? Do they want to work with the borrower? Do they want to try to sell off the loan at a discount, take their loss, and move on? Do they need to sequester the property? Do they need to manage the property? Do they have reliable property inspectors and contractors available to fix up the property if necessary? Do they want to sell the property at a loss? If so, they have to justify that. And their ability to do some of these things may be impeded by a borrower's bankruptcy. And last, they may decide to sell the loan or a group of defaulting loans short or on a discounted basis to a vulture fund. The last couple things they're concerned about is if this gets in front of a judge, will the judge be able to force a cram down on them or restructure the loan? Now, we had some bankruptcy reform a few years ago that took away a lot of the powers from the bankruptcy judges and their ability to create cram downs and restructuring of mortgages. Now, with all these major defaults, we're again seeing talk in Congress about restoring some of those powers to these judges. Time is always an issue when a default occurs. Are they moving in a timely fashion? Are they moving too slow? If they move too slow, market conditions change, and if the borrower is allowing the asset to waste away, the wasting away and deferred maintenance continues to increase. And as before, we talked about some special problems with the CMVS people, and as we get to slide 20, we can discuss that more. I'll be glad to pause now and take some of these additional questions.
Excellent, Bruce. We do have a question here from Sonia who asks, what are the adverse effects of accepting a deed in lieu for the mortgagor whose property is underwater?
What are some of the adverse effects of taking a deed in lieu?
Yes, for a mortgagor whose property is underwater.
Well, the deed in lieu really is a negotiation between the lender and the borrower, where the borrower says, I give up. You take the keys, you take the property. Now, when you do that, it's a matter of how well the negotiations are conducted generally by borrower's counsel. And let me stop here and say that I always recommend that borrowers have not only counsel, but really highly experienced real estate counsel when they get into a foreclosure situation. The problem you have is the borrower borrowed, let's say, $10 million. And the value of the property perhaps has fallen to $8 million. And so the borrower doesn't see any wisdom in continuing to pay the money necessary to improve the property and continue to pay the debt service. So he gives up, and he tells the lender, I'm going to hand you the keys, deed in lieu of foreclosure. It's a fast-track process. Well, that's fine, except in that event, there's a forgiveness of debt. The sale price of that property will be the $10 million, but he only owed, the sale price will be $8 million. The lender will bid it at 10. They'll take it at 10. The deed will reflect 10, but there'll effectively be a forgiveness of debt of $2 million. And a forgiveness of debt of $2 million is a taxable incident in the year that it occurs, so that the borrower will have an ordinary income in that example of $2 million that if they're not able to shelter in some other fashion, they will have to pay income tax on in that year, even though they didn't receive the benefit of any physical money. I hope that answers the question.
Excellent. Thank you so much, Bruce. We have another question. During the presentation, you've mentioned TIC, or TIC form of ownership, a couple of times. Can you expound on the TIC, or TIC form of ownership?
Yes. It's called tenant in common, and it's exactly that. It's a vehicle that I guess somehow started to become enamored to buyers and investors around 2005 or 2006. And the majority of these TICs are owned by small investors who had other real estate that they sold, and via 1031 exchange swapped their interest in the small property that they sold into an interest as a tenant in common in a larger property. And so the problem you have with these tenant in common situations is any decision by the tenant in common has to be unanimous. Now, some of the properties that I've looked at have been created by a sponsor. For example, a major real estate firm that I'm aware of created 135 TIC investments all around the country, all different properties. And so they were the sponsor that got individual investors to invest in these individual properties. Many of these individual properties have 25, 30, 35 investors. Now, the properties get into trouble. The sponsoring real estate company, they made their money. While they may still be getting some management, in most cases, they either are unwilling or don't have the ability to put additional funds into these individual investments. And the TIC investors, by and large, don't have any money to put in. And there's no decision, so that the management company says, hey, we lost 20,000 square feet, and we were getting $25 a square foot. It's a bad market. I got a brand new tenant who'll come in for 3 years. It's only $22 a foot, but that's the market, and we need $30 a square foot to pay the borrowers, the broker's leasing commissions, and the tenant finish. Nobody can make the decision. They have to poll all of the TIC investors, and if one TIC investor says, I don't have the money to contribute to this, to cover that $30, and so I vote no, the whole deal goes down. And so the property languishes, and ultimately it goes into foreclosure or bankruptcy because of the paralysis of the ability to get a unanimous decision.
Okay, great. Thank you, Bruce. I don't see any other questions in the queue, so why don't you continue on with the presentation?
All right, Matt, there are a couple others, so...
Okay, go for it. Sorry, I didn't see them, Bruce. Go ahead.
No, I was going to say, why don't we defer them to the end?
Okay, excellent. Sounds good.
Whoever's asked the questions, if you'll just hang on at the end, I'll come back and pick them up. How's that?
I think that's perfect. Thank you, Bruce.
All right, let's move on. Let's talk about the borrower issues when a default occurs. I guess the primary one is really the borrower's inability to refinance or sell the property for what is owed. And the inability or the borrower's imprudence to decide to cover any difference between what is owed and what can be obtained via the sale or refinance. The property owes $10 million. It could be sold for $8 million. There's $2 million of a shortfall there. He doesn't want to pay the $2 million, so he allows it to go into default, and he either negotiates with the lender that the lender will not sue him for that $2 million, or the lender will not waive that, and the property goes into foreclosure, and the lender puts a $2 million judgment against the borrower, and the borrower has to deal with that later. If there's a short-term problem, often the borrower can ask for a waiver of amortization and maybe even some interest accrual if he can demonstrate to the lender the reasonableness of a plan that will allow things to turn around and be able to restore full debt service or a renegotiated debt service in a reasonably short period of time. As to credibility, the borrower has to have the ability to prove that any projections he gives to the lender are accurate and that the property can turn around. And if they're unrealistic, he's damaged his credibility and the lender will not agree. Of course, the borrower can ask for the lender to extend and pretend. He can ask for a restructuring. He can walk away, or he can decide to fight to retain the property, often through bankruptcy. He has to be concerned about a credit blemish, whether he gives a deed in lieu or whether he files a bankruptcy. He has to be concerned about the high cost of legal fees that may be incurred to defend his position if he's going to fight to keep the property. He also has to think about the source of funds necessary to pay ongoing tax and operating expenses for the property, as well as cover the deferred maintenance and any required tenant finish and leasing commission costs to attract new tenants, which is most significant for office buildings. And he has to think about the legal as well as practical concern about the lender's successful ability to sue for damages. Is he a judgment-proof type borrower? That'll enter into his thinking. He's going to look at the financing to see if he had recourse or if it was a non-recourse loan, but he may or may not have some liability under the carve-out provision. And back again, he can offer a deed in lieu, perhaps on a negotiated basis with time to cure, meaning that he'll say to the lender, I'll give you a deed in escrow for 9 months. I'm going to continue to operate the property. I think I can turn it around. Here's what I'm going to do. The lender says, I think that's reasonable. You have a chance to achieve that. But at the end of 9 months, if you haven't done that, or if you default in the interim, I take the deed in lieu out of escrow, I take the property, and I throw you out. The borrower has to be concerned about having an ability to negotiate with someone in authority on the lender side to act. Can they deal with the lender directly? Does the lender have a workout department? Does he have to deal with a lender's intermediary? Or if the loan has been sold on a discounted basis, is he now dealing with a new entity such as a vulture fund? In my experience, if the loan is sold on a discounted basis to a vulture fund and the borrower moves quickly, he probably has the best chance to negotiate something to recapture the property or continue to hold the property and get a nice restructuring of the deal, because the vulture funds, they buy these things at a deep discount with an eye towards working with the borrower and either foreclosing and selling for more than they bought the loan for, or working out a nice restructuring with the borrower where they believe over time not only the borrower but they will come out with a handsome reward for buying the loan at a discount. Time is important to the borrower just as it is to the lender. The borrower has to think about the benefits and detriments of filing bankruptcy. He has to think about any income tax concerns and consequences if this results in a forgiveness of debt. And of course, if he rolled into this deal from a 1031 exchange, there's the additional tax from the deferred basis of that 1031 that was created years ago. All right, let's talk about some of the special problems with the CMBS loans that are in foreclosure. CMBS loans, hopefully you all understand, were chopped up into different layers of risk which were called tranches. And generically they were called the A piece and the B piece. But the A piece was chopped up into tranches and the B piece was chopped up into tranches. The A piece meaning all of the tranches were investment grade rated or higher. The B piece meaning no investment grade, literally down to junk bonds. So you have to be concerned with the number of tranches that exist in the pool wherein the CMBS loan exists. As I said previously, the interests of each of those tranche holders are in conflict. The ones that are AAA, AA, A are usually aggregating 50% or less of the original value. So even though the value of the property may have declined to a point below the total aggregate debt, it's rare that it has fallen below 50% of the original value. And so the tranche holders at that low level of up to about 50%, they know that if the property sold even at a massive discount, they will get all of their money. But the subordinate tranche holders, they're fighting to keep the property in place, fighting to get the maximum value to minimize their losses. And so you have this great conflict, and thus enters the special servicer who has the ability to come in and make some type of final decision even though they're in a fiduciary capacity and even though they must justify it. The cutoff tranche were those interests further subordinate to the total value or loan balance of the property no longer have the primary rights to control the outcome, as the present substantially reduced value of the property has wiped out their interest. It moves in descending order. They effectively move from being a secured creditor to an unsecured creditor, and let me explain that a little bit. Let's assume that the last tranche holder was owed $500,000, but that the value of the property has declined so much that his $500,000 is in excess of the liquidation value of the property. That tranche holder no longer has the ability to have any say about what happens to the property. He's wiped out. He effectively becomes an unsecured creditor who may or may not get any money. And so the decision-making process that the special servicer has to be concerned with is a consultation on a declining interest basis with those tranche holders. And as the value of the property continues to decline, the lower subordinate tranche holders fall out of decision-making process until you get down to the last tranche holder who's got that last nickel that can be covered by the sales price. Again, there's a conflict between the rights of the interests of the holders of the various tranche levels and the special servicer and their desire to keep making a management fee. When Warren Buffett formed Berkadia to do this, he made a major comment that he was doing this to make the management fees. So there are hundreds of millions of dollars of management fees out there that these entities that have been created and have lots of employees do not want to give up very easily. There is a disincentive there because of the management fees or owned equity position. They don't want to move the property until they have taken out as much for their management as the property's insufficient cash flow allows. Once the property is sold, obviously they stop earning their fees. And there is an unwillingness in most cases to obtain a current appraisal to establish current value. So as a borrower's attorney, those of you that are listening, here's an opportunity for you to force that issue by obtaining an independent appraisal expert and going on record with the special servicer about the value of the property. I say again, often these special servicers do not have the ability to properly review such appraisal and know if it's correct or incorrect. They are often untrained, and there is more to an appraisal than just a number, as I previously reviewed. The special servicer has no source of money available except from the property's cash flow to perform deferred maintenance and or fund tenant finish and leasing commission costs to attract new tenants. Sometimes, without paying debt service, the special servicer does have enough money that he can say, let's take that tenant at the lower rent, let's spend the $30 a square foot. It's good for the property overall. Other times they're paralyzed because there isn't enough money there to do that. And of course the servicer always has a fear of being sued if they make the wrong decision. It's easier to make no decision than to make a decision that can be considered subsequently as wrong. Any decision a special servicer makes must be properly documented and supported. So as we finish, I'd like to leave you, before I take those last few questions, with a few tips in foreclosure for borrowers and lenders. For borrowers, I recommend that you communicate early and in a face-to-face meeting with the lender. Always be truthful. Do not exaggerate. You must establish credibility. Hire an experienced real estate attorney. Decide whether you want to take them to the first meeting or not, but always get their advice. You want to propose a reasonable plan to the lender. Lenders are knee-jerk reactionaries. If you don't make a proposal to them and you expect them to make a proposal, you'll be sadly disappointed. Keep documentation of everything you do, and I strongly recommend that every time you have a face-to-face conversation or a telephone conversation, as soon as possible, write a memorandum to yourself, vividly recording exactly what occurred in that conversation. It's dispository evidence later if you ever need it. Be prepared to move quickly to bankruptcy if the lender is unresponsible or you find that they're stalling. Sometimes they talk out of the left side of their mouth saying, yes, 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 we'll reconstruct your loan, and in the midnight hour out of the right side, they hand you the foreclosure and say, our attorney said to do it. For lenders, move cautiously but expeditiously. Try to meet face-to-face with the borrower. Don't live in an ivory tower, hide behind emails and voicemails. Get out and inspect the property. Many times they don't do that, and they're fooled later when they find the property is either better maintained or not as well maintained as they thought it was. It will influence the decision going forward. Perform a preliminary in-house valuation of what you think the property is worth and what it will cost you if you foreclose and what it will cost you if you work with the borrower. Decide to keep the borrower in place or not keep them in place. Sometimes the devil that you know is better than the devil that you don't know. You absolutely must develop a game plan, including creating a workout department or a policy of discounting your loans at sale. Again, keep documentation on your side of the table, including creating memos right after you've had a conversation face-to-face or telephonically with the borrower, and vividly record what occurred during the conversation. I hope you have found this webinar to be interesting and informative, and if you don't mind, I will now take a minute to catch up on these past couple questions. Question from Michael: where there is a swap agreement, can the bank which is holding the mortgage effectively negotiate a standstill agreement or renegotiate the loan where the mortgagee is still current, but the projections indicate that the property income will meet debt service in the absence of an increase of occupancy from the current 50 to at least 65%? Very interesting question. If there's a swap agreement in place, as long as the debt service is being paid, usually the swap lender will do nothing. If you need to unwind the swap, if you're a lender and you're foreclosing and you need to unwind the swap, then you have to watch the prepayment penalty, because it's usually tied into a yield maintenance type provision, and if there's a lot of time remaining on that swap agreement, and if the spreads are dramatic, you could be looking at a tremendous amount of money. But I say as long as the property has the ability to pay the debt service, because the debt service goes to the swap lender, and the swap lender then takes out of that the amount necessary to pay the first mortgagee, and they pay the first mortgagee. The problem is that if the swap lender defaults, if they go bankrupt, the borrower is still liable for the higher rate of interest that the swap was supposedly protecting and was no longer protecting. So I hope that answers that question. And there's another question from James. James, you've asked, is a tax on an individual in a forgiveness of debt scenario dischargeable in Chapter 7 bankruptcy? I would have to defer to a bankruptcy attorney on that, mainly because, as I indicated earlier, some of the rules concerning bankruptcy, we had a bankruptcy reform about 3 or 4 years ago, principally aimed at individuals who were defaulting on credit cards, and they were filing bankruptcies to avoid having to pay what was owed to the credit card company. Now, sometimes, how you write one law not only affects the class you were trying to address, but it affects everybody. So I think you need to speak with a bankruptcy attorney to absolutely get the answer to that. Here's another.
Excellent, Bruce. I have some questions that were submitted to me. I think there are 3 in the queue. If you don't mind staying on the line and answering those.
Go right ahead.
Excellent. We have a question here from Michael, who asks, where the property is encumbered by a mortgage and the borrower has also entered into a swap agreement with the same institution. You already answered this question for Michael. Is there any ability to negotiate a modification?
Well, there's always an ability to negotiate a modification, but contractually that's not anticipated. The hammer that the swap rate lender has is the unwind via the yield maintenance. Now, of course, sometimes it goes the opposite way, but right now that's not the case. When rates would go up above the swap rate, and the swap rate lender had to start reaching into its pocket to cover the difference in debt service, the swap rate lender would actually offer you money to unwind the swap. But the majority of the swaps that have been done that exist today were done 2, 3, 4, 5 years ago when interest rates were higher, and interest rates are much lower today. So they're making pretty good vigorish on that. So to unwind a swap, you would have to pay that prepayment premium. But I guess you could always negotiate with the swap lender. The question is, why would the swap lender want to do it? If there's a default, I think they'll just follow the document and do what the language requires in the event of default.
Excellent. We have a question here from Todd who asks, would debt forgiveness 1099 occur in a standard foreclosure?
Debt forgiveness 1099?
Yes.
Ask that again, Matt.
Sure. I apologize. Would debt forgiveness 1099 occur in a standard foreclosure? I guess he's talking. I don't know what he's talking.
Yeah, would somebody send you a 1099 for the phantom income, right?
I think yes. I think that's what he's asking. Yeah.
I say the answer to that is yes. You always have to be concerned about the forgiveness of debt. It's an ordinary income to the entity that received the benefit of the forgiveness of debt.
Excellent. And we have a final question here from Sonia who asks, what is a cram down, and under what circumstances can a mortgagee move successfully into bankruptcy court for a release from the automatic stay?
Well, it depends on the state that you're in. And I'm not familiar with all the state laws, but yes, they can petition in the court and argue that the automatic stay in bankruptcy was unnecessary. But I gather from experience, most bankruptcy judges will issue a stay immediately for 30, 60, 90 days because they don't have the time to look at the case. Somebody comes in and says, you went into bankruptcy, please forestall the foreclosure, put a stay on it 30, 60, 90 days. They do that to allow both sides and to prepare better arguments so that the judge has an opportunity to understand both sides and make a decision. The lender's position to argue on a stay is allowing the borrower to remain in control. He will waste the asset, and the value of the asset will decline. So give me the property right away so that I can make sure that the value is maximized so that I get back as much of my money as possible. That's my understanding about a stay, and that's my understanding about the argument. Did I cover that question?
I believe so, yes. And we have a final question here from Todd who asks, is there recourse against broken lender promises to extend other than a court action?
Well, yes. I personally have been involved in a few cases where lenders have promised to do something and the borrower has relied upon that, and then the lender changed their mind, and to the detriment of the borrower, there were damages. I was involved in a case many years ago in Pennsylvania where the lender, a bank, actually took the property away from the borrower even though they stopped funding the construction loan. They were contractually obligated to fund the construction loan. And so when the property was about 2/3 completed, they stopped funding the loan, arguing that the borrower's personal financial position had deteriorated and the market had deteriorated and they weren't so sure that the property was going to be a success. Well, that's not what the document required. So the borrower actually filed a lawsuit. About 2.5 years later, he won the lawsuit. He got his property back with massive award of damages against the bank. So if you have witnesses and if you have best evidence that a bank has said they were going to do something and then they reneged, in my opinion, and of course all of the counselors listening today can give you better advice than I, you have a cause of action against that institution.
Okay, Bruce, I apologize. One final question. Going back to the question Sonia asked, the first part of it, can you discuss just briefly what a cram down is and how it works?
Sonia, I apologize. A cram down, prior to these bankruptcy changes, when you would get into a bankruptcy, the property owner would say to the judge, Your Honor, look, I had a $10 million mortgage on a $13 million property. The property's value has now declined to $12 million. I can demonstrate and do demonstrate that I can afford a $9 million mortgage. I can't afford it at 8%, but I can afford it at 6%. If you give me a $9 million mortgage for 5 years at 6%, this thing works. The judge turns around and says to the lender, your $10 million mortgage is now crammed down to 9. Your high interest rate is now crammed down to 6. Live with it. My final decision off into the future. And that's exactly what would happen. That's a cram down. They cram down the loan. I see one final question here, Matt, if I may.
Oh, go for it, Bruce. Yeah, definitely.
From Michael, how does a bank treat technical default, such as a failure to make the debt service coverage ratio? The bank has raised the issue. That's an interesting question. I've actually been confronted in the last year or so a couple times with some clients of mine. When they do the loan is fine. It's 75% of value, and the debt service coverage is 125. But they oftentimes will put a covenant that says the borrower has to maintain a 1.2 debt service coverage ratio on an ongoing basis. My experience is two things. You can't look at it at a month in time. You have to look at it on an annual basis because, if a tenant moves out 1 month and you replace them the next, the month it was vacant, you may not have your 1.25 debt service. The month that you release it, you certainly have the 1.25. So the first thing is you want to make sure that that's on an annual basis. Secondly, unless the lender really is a bad guy, and let's face it, not all lenders are good guys, they should just continue to allow the loan to go and maybe ask for some temporary additional collateral or maybe an increase in an individual's personal guarantee until such time as the debt service coverage covenant is again met on an ongoing basis for maybe 6 months or a year. Now that all assumes, however, that there's a positive cash flow to the property, that there is some form of debt service coverage, be it 105 as opposed to 125, and not a negative debt service, meaning that the debt service exceeds the net income. If the debt service exceeds the net income, I think you have a much bigger problem trying to negotiate something with the lender. But a combination of temporary additional collateral, reasonableness on both parts, or a pay down of a portion of the loan to bring that debt service coverage back into alignment seems to be the solutions that come out of a lender declaring a technical default over a debt service coverage issue.
Okay, great. Thank you so much, Bruce. If there are no other questions, I don't see any. Bruce, do you have any on your end?
No, and I'd like to thank everyone for participating today and giving me the opportunity to hopefully enlighten you about some of the issues in foreclosures for borrowers and lenders.
Excellent. Well, thank you so much, Bruce. I think your PowerPoint was great, and it's clear that you put in a lot of time and effort, and also that you're very passionate about this subject. I think that came through in your presentation. So please thank you for all the time and the effort that you put into the presentation. For those who are still on the line, we'd just like to wrap things up here very briefly. If you'd like to speak to Bruce about a case or a project, a consultation, please contact us here at TASA. Our telephone number is 800-523-2319. As I said in the introduction, we will be sending out a link to the archived recording of this webinar tomorrow morning. This archived recording, as well as the archived recordings of all the webinars we've done, and we do about 3 a month, are found in the TASA Knowledge Center. You can go to our homepage, tasanet.com, and click on the top-level navigation that says Knowledge Center, and you'll be taken right to the webinar section. If you have any follow-up questions or comments, ways in which we can make these programs better, please email me at mi@tasanet.com. You'll get a follow-up email from me at 3:30 this afternoon thanking you for your attendance. And then tomorrow morning I'll send out an email with the PowerPoint and the link to the archived recording. You can respond to any one of those emails. And please do take a moment to fill out the survey that will appear on your screen as you leave the meeting. it helps us put on better programs. On behalf of the entire TASA team, thank you to Bruce, thank you to everybody who spent an hour of their time with us, and we look forward to seeing you at future events. Thank you so much.
Thank you, Matt, very much.
Thanks, Bruce.